if the middle class wants to survive, one of the best things they can do to preserve their purchasing power is owning gold. If you take the bottom 50% of people that live in the United States and take their wealth combined, it is negative. Let me say that again. The bottom 50% of Americans, if you combine their assets, it is negative. They have a negative balance sheet. So if you want to stay in the middle class, if you want to have any semblance of a possibility of maintaining your purchasing power, you need to get some exposure to physical gold. End of statement.
Welcome back to Finance and Liberty and Reluctant Preppers. We have a first-time guest, Michael Pento, the founder of Pento Portfolio Strategies, joins us. We've had a number of viewers' questions submitted ahead of his visit, and he comes highly recommended by many of our viewers. Michael, thank you for joining us this first time.
It is my pleasure. Nice to meet you.
I wanted to mention that the date today is Friday, January 17, 2020, and before we get into viewers' questions, I'd like to see if we could ask you about a recent article that you wrote about the plight of the middle class and what is ahead for those who are trying to make it through these times. The stock market's definitely been hitting new highs day after day after day, but that doesn't necessarily trickle down to everyone in the middle class, and there's been a lot of other factors that are affecting people's real experiences in their lives. So could you bring us up to date on what you're seeing the situation for the average American to be, and what you think the major factors are that are driving that, and what direction you think that's continuing?
Well, the middle class is going extinct, and I don't think the middle class cares very much about the repo market, for example. You have a central bank that's injected $500 billion of fresh money since mid-September into the repo market, into its balance sheet. The Federal Reserve's balance sheet has grown by $500 billion, $500 billion, to try to make Jamie Dimon and the richest of us in this planet more wealthy. But that doesn't affect the 80% of U.S. citizens who live hand to mouth, paycheck to paycheck. They have to spend upwards of 60% of their entire income on the necessities of life: food, clothing, shelter. I'm not even including medical expenses or college tuition. They spend a greater proportion of their income on the necessities to live. But Jamie Dimon et al. Are getting richer and richer. And as a matter of fact, their incomes, the top quintile income in this country, is growing their wealth 5 times faster than the middle 3 quintiles done again. So the middle class income is stagnating, while the very rich among us are getting wealthier and wealthier. And it's no mystery. It's precisely because the Fed is debasing the dollar's purchasing power. It is inflating asset prices, where now 1% of the entire world's population, the top 1%, owns more than 50% of the global population. So it's not just the Fed, it's central banks across the planet. So you're seeing the middle class become eviscerated, it's going extinct, all for the glory of bankers and Wall Street, so they can become richer and richer. And we don't have really a vote in that. We didn't vote for the Federal Reserve to take interest rates to 1.5%. We didn't vote for the ECB. The citizens of Europe didn't vote for the European Central Bank to take interest rates below zero. The Bank of Japan, below zero. This is replete across the planet. We have $11 trillion now of negative yielding sovereign debt. We have $500 billion worth of corporate debt in Europe that trades with a minus sign in front of it. This is the biggest distortion of asset prices ever. And that is why the rich are getting richer and the poor are getting poorer.
We have a question from a viewer that follows up on what you're talking about, is the plight of the average person and what we've become accustomed to. Hike Frost asks, many of us say, quote, once this begins, talking about like another global financial collapse, but it has begun for some time now, and we are all frogs in boiling water. The question is, when does it get bad enough that the public begins to really notice that we are facing a serious crisis?
So great question, Dunnigan. So Right now, all we see is record high after record high on Wall Street, and the unemployment rate is very low. It's at 3.5%, so it's at historic lows. And initial unemployment claims just came across Friday today at 200, I think 204,000 or 205,000. So that also as a multi-decade low. So you're not really seeing the rubber hit the road yet. But when you do see the rubber hit the road, when this starts to get saliently painful, is when we have a rise in the unemployment rate. And that is going to be the progenitor of that, or that will be engendered by a blow up in the junk bond market. And that is going to be caused by inflation. So whenever the central banks are able to achieve their 2% inflation targets, that's going to blow up the junk bond market and the sovereign debt bubble. And by the way, it might also happen not through inflation, just because the credit quality of these junk bonds becomes so eviscerated that they start to drop in price and the yield spikes. That's also a very good possibility. But until one of those two things happens, the central banks achieve their inflation targets, it starts to run intractable, blows up the bond market, both on the sovereign debt level and the corporate bond level. Or we just have a business cycle that deteriorates to the point where you see the junk bond market blow up. That will cause people to sequester into treasuries and in sovereign debt, but it will blow up the junk bond market. And then you see, according to the IMF, 40% of all corporate debt will be owned by zombie companies that can't afford the interest payment on their debt. That lies in the future out there. But until then, we can just, merrily skip along, blowing up asset bubbles, taking the stock price. The stock market right now is at an all-time high, its market cap relative to GDP. Never been higher, even at the height of the dot-com bubble. It was never this high before. If you look at the Wilshire 5000, the market cap of that index, 5,000, so that's a little bit less than 5,000, but it's the broadest market measure. As the numerator and the denominator is GDP, it has never been higher, even in the mania of the dot-com bubble. So we have an epic crash coming. Don't try to use hyperbole here. This is something we have never seen before. The distortions and the malformations in the corporate bond market and in the stock market and in the sovereign debt arena have never been worse. And when that blows, watch out.
We have a question from Jacques Bourne who says, what significance do you place on the United States tripling its oil production in the last few years while suffering losses?
Well, that ties directly in with the corporate bond market. So, we are becoming more and more oil independent, and that is a good thing. If you take out the dangers involved with fracking and the harming of the drinking water and the possibility of engendering earthquakes, I'm not going to get into that ecological discussion here. But a lot of these companies have a lot of junk debt. And these wells deplete very, very quickly. So all of that is on the come. Once the corporate bond market freezes again, just like it did in December of 2018, you saw the Russell 2000 lost 30% of its value in the fourth quarter of 2018. People forget about that. They only concentrate on the 29% S&P 500 growth in 2019. That's great, Yahoo. But they forget about the fact that the Russell 2000 is still not at a record high. It's still below because it crashed, absolutely crashed in the fourth quarter of 2018. But these companies, when these companies get shut out of the credit market, they will no longer be able to roll over that debt. And that's when you'll see the fracking industry blow up. And that'll be all part and parcel of the implosion of the corporate bond market.
We have a question from Mark Marquardt who says, Texas recently opened a state-backed bullion depository. Would gold and silver held in this facility be immune from federal confiscation because of jurisdiction limitations?
Well, you have to have a constitutional lawyer answer that question. I can't really answer that question. I tell you this, this is what we do know, that all laws are fungible. Okay, they can be wiped out at the whims of government. We know this. In fact, look, the Federal Reserve had absolutely no authority to purchase any kind of debt other than treasuries. They had no legal right to purchase mortgage-backed securities prior to the Great Recession. But in an emergency, just like President Lincoln banned habeas corpus in the Civil War. In an emergency, the government can do anything that it wants. That is not my opinion. That is a proven historical fact. So, confiscating IRAs, changing the tax rates ad hoc because the government needs money. That's all in our future, unfortunately. And confiscating gold has been done before. Roosevelt did it. So, I can't comment specifically on the state of Texas. Be a massive legal battle. So it's something that would take some time. But if I look at it this way, there's two types of ways you can get exposure to gold. Dunnigan, you can either buy a proxy or a derivative of gold mining shares, or a physical gold ETF, or you could have the gold in your possession physically. And everybody should have some proportion of their wealth in physical gold that they themselves, outside of a third party's rule, have access to. 5%, 10%, that's your starting base point.
We just had an interview with Rick Rule of Sprout Asset Management, and he shared a statistic that I was not aware of. He said that the percentage of holdings in gold or precious metals assets is at an all-time low since the recording happened, at less than 0.5%. And he said,
wow,
the peak was at 7% after the last financial collapse, and that the average in the last several decades has been 3%. So we're a long way from that. So underscoring the need for people to not be out on that extreme confidence fringe, risk on fringe.
If the middle class wants to survive, one of the best things they can do to preserve their purchasing power is owning gold. If you take the bottom 50% of people that live in the United States and take their wealth combined, it is negative. Let me say that again. The bottom 50% of Americans, if you combine their assets, it is negative. They have a negative balance sheet. So if you want to stay in the middle class, if you want to have any semblance of a possibility of maintaining your purchasing power, you need to get some exposure to physical gold. End of statement.
You've brought up the future a couple of times here, and that's where this next question goes. Longo Where To says, could Mr. Pento draw us a picture of his expectation for his job in 10 years? Where will the banking system survive? Where will socialism take over? Where are the dark and where are the bright spots for the invested money on his world map in a decade?
Well, just to impulsively answer the question, there's been a huge push towards passively managed portfolios. So you see now that the top 4 companies in the S&P 500 now have a market cap of $5 trillion. 4, Dunnigan. So there's been a tremendous push towards owning the same assets in the same ETFs. So all these ETFs that are basically just closet index funds are all pushed into the same stocks. In fact, the top 5 stocks, so I think it's Netflix, Amazon,
Microsoft,
and Facebook is the 5th one. Mm-hmm. I think I got that right, but close if I'm not exactly accurate. The 5 stocks, the top, but this is the fact. 5 of the biggest companies in the S&P 500 own 18% market cap of the index. Right. So everybody's passively crowded into the same 5 holdings. So where is my industry going? I believe that there'll be a really wonderful opportunity for active managers who have a good model. So I have a 20-point model called the inflation, deflation, and economic cycle model. I'm an active manager. I am actively trying to participate in a hedged fashion in this gigantic, unprecedented bubble in the stock market, and I've done so. But the most important thing is I want to make sure I protect my clients' wealth by measuring and mapping when this collapse begins. So I have, like I said, 20-point model. I look at break-even spreads, LIBOR spreads, high-yield spreads, initial unemployment claims, real Fed funds rate minus inflation, but measuring it by the break-even spread. So I don't want to get into the whole 20-point model and get into the weeds. But I'm trying to not only protect my clients' money, but then short the market as it begins to roll over, because I believe wholeheartedly, unfortunately, that the market is going to lose 50% of its value plus, 50 to 80. And it's going to be for the third time since the year 2000. And the reason why I say that is not because I'm trying to scare people or use hyperbole, but as I said, the total market cap of GDP has never been higher. So that's proof positive right there that we are in a massive, unprecedented bubble. And we look at the fact that there's a record number of IPOs that are listing on the New York Stock Exchange, don't make any money. The amount of, I believe it's now 40% of all listed shares don't make any money. That's a record high outside of recessions. So the construct, and as I said, just like we had the Nifty 50 and the dot-com bubble, all of these funds own the same few stocks in various weights. So it's going to be a massive burst of this bubble, and I want to be able to short that and capitalize that for my clients. So for the answer to the question, for individuals like me, it's going to be a renaissance, a rebirth of the active manager, and hopefully the more of the attenuation of passively managed funds. But to more precisely answer the question too, I think the question also wants to touch on the solvency of the banking system. We are going to have a time in this country where there's going to be a massive reset. I believe there'll be a massive deflationary reset of the currency and of debt. And in that case, you're going to see a lot of financial institutions go under. But that's going to be in a response to the intractable hyperinflation that comes via universal basic income and helicopter money. So universal basic income and helicopter money. So the great reset is going to occur as a consequence of that inflationary crack up. That we haven't had that yet. So we have some time before that occurs.
Interesting. Drew Cave asks, Michael, what is your opinion of the future of digital assets, specifically Bitcoin as a store of value?
Okay, so this is not going to be a new territory for me. I've always been and have been wrong for many years. I've been very, very against any kind of digital currency, because the primary goal of a digital currency is to have be able to conduct money, transact currency, move money around the world outside of a third party. Okay, so you're anonymous and you're unable to be thwarted by a government, which is fine, except governments don't really enjoy having their money, the power of money, being usurped from them. So you have to comply with anti-money laundering. You have to know your customer. And if you try to trade around governments, they try to block you, which is exactly what's happening with Bitcoin and all the other, I put them all together, all the cryptocurrencies. So so now cryptocurrencies say, well, okay, let's be regulated by governments. Well, if you're regulated by governments, then how do you circumvent the banking system? I mean, what kind of anonymity do you have? If you're not anonymous, it's supposed to be a transaction that's anonymous and incapable of being changed, immutable. It's an immutable transaction. But then you want to be regulated by the government. So then what purpose is it? Then you just have a 64-bit encryption, numerical and alphanumerical elliptical algorithm, a private key that sort of resembles a barcode. It's unique, like a barcode, but it's only the only thing that gives Bitcoin or cryptocurrencies value is their ability to transact outside of the banking system. So I think it's going to be something relegated to the dark web, and there's only certain illicit activities that occur on the dark web. It won't be the mass adoption of cryptocurrencies will never occur, in my opinion, because you're not going to have a mass rush to transact goods and services on the dark web. So they'll be relegated to the dark web, and there'll be always be a place for cryptocurrencies, especially in a hyperinflationary economy when you try to move money overseas outside of the government. But as far as the Tom Lees of the world that say it's going to 100,000 or 20,000 per unit, I don't think it'll ever happen. I do, however, see a role of governments enacting a cryptocurrency that hopefully is backed by gold. There you have something there. That would be a wonderful marriage between physical precious metals and electronic currency. That I see occurring in the zeal to take interest rates negative around the globe. You open yourself to a run on the banking system because no one's going to accept a negative rate on their deposits, especially if it's greater than 1 or 2%. So in order to obviate that condition, they will, I think, resort to cryptocurrencies, some type of government-sponsored cryptocurrency, which means you can only keep your money in the banking system or spend it. You cannot hoard it. You cannot take physical possession of it.
Yeah, Christine Lagarde, the new head of the European Central Bank, had that infamous statement that she made about a month ago talking about we should be glad to have our jobs rather than our savings when they implement negative interest rate policies. It's horrifying to think that a worker doesn't have the right to the fruits of their labor.
Yes. And at the whims of the government can be completely wiped out through the purchasing power loss. That's all coming. That's unfortunately. That's why if you can take physical possession of your gold now is a great time to get some.
Well, I see that we're out of time. If people want to find out more of your work, and I have to commend you that the tenor of the questions that we had submitted by viewers was so deeply recognizing of the reputation that you've built with people over the time. They really do want to follow your work and find out more of your writings. Where can they do that?
So the website is pentoport.com. First of all, let me say it's a tribute to you as well as me, and more so you. So your audience is spectacular, and you must have a very intelligent broadcast here. I wish you the best of luck, Dunnigan. So it's not just a credit to me, it's a credit to you, too.
It's a service trying to help people, and I appreciate that.
Okay, so it's pentoport.com. You can come to the website and download a free podcast. It's a 5-week trial, and if you like what you see, it's $49.99 per year. And I'll give you my macroeconomic view every week on Wednesday. You get it, 52 weeks a year. And also, if you have around $100,000, you can actually become a client, and then I'll manage your money personally in the inflation, deflation, and economic cycle model. And I think that's the best way to participate in the bubble while it lasts, but then most importantly, to make sure that your purchasing power and standard of living increases in the next crash. That's what my specialty is, and that's what I intend on doing with God's help.
Well, we've got to have you back because there's many more questions than we had time to ask you today, but just grateful for your first visit here on Finance and Liberty. Michael Pento, founder of Pento Portfolio Strategies. Thanks for joining us.
It was my pleasure. Thank you, Dunnigan.
They say the stock market crashed today.
Yeah, I heard that.
Sounds like people's retirement accounts and savings accounts are going to get bailed into the banks.
Yeah.
Looks like pension plans and Social Security are going to get suspended too.
I know.
Sure, I'm glad we decided to put our money into gold and silver instead.
Me too.
Get your gold and silver and support this channel at goldsilver.com/AFF=RP. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.